Welcome to FXTech's comprehensive Euro USD analysis for November 10th through 15th, 2025. This week, we witnessed choppy consolidation as the pair traded within a narrow range, reflecting market indecision amid mixed signals from both sides of the Atlantic. Congressional progress toward a U.S. government shutdown deal provided mild support, while diverging Eurozone economic data complicated the outlook. We'll examine critical technical levels, fundamental drivers, and provide actionable trading strategies across multiple timeframes. This analysis draws from TradingView, Investing Live, Action Forex, and Daily Forex to deliver you the most comprehensive market perspective. Let's dive into the details. Euro USD spent the week consolidating in a narrow range between 1.16060 and 1.16537, closing at 1.16207. The pair gained 0.59% over 5 days, but remained down 0.22% for the month. Year-to-date performance stands at an impressive plus 12.22%, reflecting the euro's broader recovery from 2022 lows. Technical indicators across the board, oscillators, moving averages, and overall summary, all registered neutral, perfectly capturing the market's indecision. Trading volume reached 198,710 contracts as participants awaited clearer directional signals. This choppy action reflects uncertainty as traders digest U.S. government shutdown resolution hopes alongside weakening Eurozone sentiment data. Neither bulls nor bears could establish a decisive advantage. 3 critical resistance levels are preventing Euro USD from breaking higher. First, 1.1727 represents the primary resistance. A firm break above this zone would solidify the bullish case and bring the 1.1917 high back into focus. Second, the psychological 1.17 barrier needs to be cleared to spark momentum. Third, the weekly high at 1.1655 serves as an immediate hurdle, with the pair's retreat after hitting this level demonstrating its significance. Additionally, the 50-day exponential moving average near 1.16 has proven critical multiple times as a battleground between bulls and bears. The inability to sustain trading above these levels keeps Euro USD vulnerable to renewed selling pressure. Only a decisive break of 1.1727 would confirm a bullish breakout scenario. 6 key support levels provide downside protection for Euro USD. The 1.1594 swing area, successfully breached to the upside on November 12th, now acts as support on pullbacks. Critical near-term support sits at 1.1561. A break below this level would revive bearishness and target the 1.1467 low. The rising 100-hour moving average was successfully defended on November 12th when buyers leaned against this level during the U.S. session, stalling the decline and pushing prices back higher. The 1.16 and 1.15 levels provide major psychological support, while 1.1467 marks the recent low. That November 12th technical event was particularly significant, demonstrating strong buyer commitment at critical support and ultimately leading to a break above the 1.1594 swing area. On Monday, November 10th, Congress moved closer to a deal to reopen the federal government, significantly impacting market sentiment. Euro USD traded near $1.1570 as a mild bullish bias emerged. The risk-on environment was evident across European equity markets, with the DAX rising 1.5%, CAC 40 up 1.4%, and the FTSE 100 also advancing. This development reduced uncertainty around U.S. fiscal policy and removed a significant tail risk from markets. With the shutdown threat diminishing, traders could refocus on economic fundamentals rather than political dysfunction. Normal data flow would resume, improving policy clarity for the Federal Reserve. However, while shutdown resolution removes a significant headwind for the dollar, it doesn't fundamentally alter the Euro USD trajectory. Eurozone economic data presented a mixed picture during the week. On the positive side, Third quarter GDP growth beat expectations at 1.4% year-over-year versus the 1.3% forecast, demonstrating economic resilience. The trade surplus surged on strong exports to the United States, indicating Eurozone manufacturers remain competitive. The European Central Bank maintained its policy rate at 2%, with inflation steadied near target, providing certainty. However, sentiment indicators deteriorated during the week, limiting euro upside potential despite the positive GDP surprise. Forward-looking surveys suggest weakening confidence, and soft data often leads hard data. This divergence between current strength and future expectations created uncertainty about the economic recovery's durability, contributing to the technical indecision we observed in EUR USD price action. The short-term outlook remains neutral, with a slight downside tilt. Two scenarios are in play. The bullish scenario requires a break above 1.1655, which would target 1.1727 and potentially 1.1917. This would suggest the three-wave correction from 1.1917 completed at 1.1467, with the broader uptrend resuming. The bearish scenario triggers on a break below 1.1561, targeting 1.1467, 1.16, 1.15, and ultimately 1.14. This would imply the recent bounce from 1.1467 was merely a corrective move within a larger downtrend. Given current choppy conditions, the recommended trading strategy is to wait for a clear break before committing. Use tight stops, favor range trading with quick profit taking, and monitor key data releases closely for volatility. The 55-week exponential moving average at 1.1306 is the critical pivot for the medium-term outlook. The bearish scenario, which carries higher probability, suggests that sustained trading below 1.1306 argues the rise from 0.9534 is complete, with targets at 1.1390, 1.14, and the 1.1250 to 1.1300 zone. Daily Forex expects 1.14 eventually, though via a choppy path lower. Bearish divergence in the daily MACD supports the view that a medium-term top formed at 1.1917. The bullish scenario, with lower probability, requires holding above 1.1306 to keep the uptrend from the 2022 low alive, targeting 1.1750 to 1.1800 and potentially 1.20. This would require breaking above 1.1727 and 1.1917, along with a Fed dovish shift and Eurozone growth acceleration. The 1.2000 to 1.2019 level, the 38.2% Fibonacci retracement of the decline from 1.6039 to 0.9534, represents the critical juncture for the long-term outlook. Scenario 1. Rejection at 1.20 would keep the multi-decade downtrend from the 2008 high intact, with the outlook neutral at best and potential for retesting the 2022 low at 0.9534, or making new lows below 0.95. The rally from 2022 would be viewed as merely a corrective bounce within a larger bear market. Scenario 2. A decisive break above 1.20 would confirm a long-term bullish trend reversal, targeting the 61.8% retracement at 1.3554 and ending the multi-decade bear market. Currently at 1.1620, the pair first must hold above the 55-week EMA at 1.1306 to keep the path to 1.20 open. In this volatile, choppy environment, strict risk management is essential. Follow 4 core principles. Never risk more than 2% of trading capital on a single trade. Use strict stops on every trade without exception. Target a minimum 1 to 2 risk-reward ratio. And build positions gradually as your thesis confirms. Current market characteristics include high volatility as a major driver, choppy action with traders uncertain about direction, and support and resistance levels becoming critical given the lack of clear trend. Monitor 6 key events closely. December FOMC for rate cut expectations. U.S. non-farm payrolls and CPI for Fed policy direction. Government shutdown final resolution. Eurozone fourth quarter GDP. U.S.-China trade negotiations. And ECB policy statements. As Christopher Lewis from Daily Forex notes, volatility is going to be a major driver. This is a market that continues to be choppy and noisy.